kind of in no man's land. If we zoom back, they've been trading sideways for a very long time. And if we zoom back even further, you can see they're still technically either in a downtrend or best case scenario, they're in a stage one base, which really, you don't really want to get involved during a stage one base when we look at stages. Stage one is over here on the right. It's also over here on the left. It's shaded red because it's trendless, it's random, it doesn't provide very good return. And so we want to steer clear of things that are in a stage one base until things have broken out and start. Taking a look at the charts today, we've got equities trading slightly lower. Yesterday, they had a nice little pop and rally. Today, a little bit of a profit taking, a little bit of a pause. When we look at the S&P 500, we are testing right up here at previous highs. So there's a little bit of resistance, natural selling there. There's also, I think, a lot of kind of energy kind of waiting to see what the Supreme Court says on Friday and what the opinion is towards Trump's tariffs, if they're going to allow it, if they're going to block it, if they're going to refund the $300 billion in extra tariffs to the companies and investors or, importers and all that stuff. Who knows what's going to happen? Likely going to create some movement. But when we look at the equities market from a short-term standpoint, we've dipped into these oversold market territories. Not really only were they oversold, but we also had some panic selling. Typically, when we get panic selling indicators spiking, we tend to see the market put in a short-term bottom and then it moves higher. If we take it a notch further to the daily chart, you can see we've got I've got my cycle indicator on here, shows when we're hitting short-term and momentum cycle lows, which you can see they're very short-lived, but overall we had cycle lows a few sessions ago. The market's put in a bit of a bounce from there. And so there's a lot of things aligning that this market has just put in a low, and we could start to see this pop and break. I think we're very close to this. I think a lot is going to be hinging on Friday's news. I think maybe some big investors are holding back from moving in until they figure out what's going to happen with the tariff news. But overall, the overall trends are up. All the key moving averages are sloping higher and pointing to higher pricing going forward.
Short-term market stress often creates opportunity, and recent price action fits that pattern. Panic-style selling briefly emerged, a behavior that frequently marks temporary lows rather than lasting tops. On daily timeframes, momentum cycles have already reset, allowing markets to rebound. While these signals are short-lived by nature, they often align with near-term recoveries. More importantly, the larger trend remains intact. Key moving averages continue to slope upward, suggesting underlying strength. Unless broken decisively, these trends argue that recent weakness is corrective, not structural. However, catalysts, especially policy-driven ones, may determine how quickly confidence returns.
Now, if we take a look at where money's flowing today, so it is flowing out of equities. We are seeing money move into bonds, seeing the long-term bonds have a nice pop and move higher. If we zoom out on the chart, again, bonds are kind of in no man's land. If we zoom back, they've been trading sideways for a very long time. And if we zoom back even further, you can see they're still technically either in a downtrend or best case scenario, they're in a stage one base, which really, you don't really want to get involved during a stage one base when we look at stages. Stage one is over here on the right. It's also over here on the left. It's shaded red because it's trendless, it's random, it doesn't provide very good return. And so we want to steer clear of things that are in a stage one base until things have broken out and started to move higher. Before I actually jump into a few more, I should just mention on January 25th and 26th, I will be presenting at the VRIC, the Vancouver Resource Investment Conference, and I'd love to meet up with anybody who wants to come to the event. I think the event is free. Last year it was a huge success. I met hundreds of investors. It was pretty cool, and it is an awesome event. I've done many different live events, and there's no doubt the VRIC has blown everyone out of the water in terms of it's huge, it's very clean and open and fun, and all the really fun people are there, and it's got a great group of investors. So if you want a really fun day, it's a great one-day tour and meet, mingo, and all of that stuff. Anyway, let's move on to the charts here. We do have money flowing out of equities this morning. Out of precious metals.
As equities pause, capital has rotated into bonds, producing a modest rally in long-term debt. Yet context matters. When viewed over longer horizons, bonds remain trapped in a wide consolidation range. This phase, often referred to as a basing structure, lacks directional conviction. Historically, these environments deliver inconsistent returns and elevated risk. Until bonds break decisively into a new trend, they remain more defensive than opportunistic. This shift reflects short-term risk management rather than long-term conviction. Investors appear to be parking capital, not deploying it. The message is caution, not commitment.
They had a nice pop yesterday. Overall, a little bit of a pullback. This morning, we've got gold down 1%. We have silver picking up speed, down 4.5%. Again, silver poked into resistance, found a little bit of selling pressure, and it's kind of pulling back. It's very similar to the equities markets, testing some previous highs, so there's naturally going to be some sellers there. If we take a look at platinum and palladium, we've got platinum down 6.7%, again, pushed up into upper end of the range of resistance. Palladium didn't really get up there, moved into the middle range here, and it's starting to see some selling, some high volume selling. So again, we're still in this consolidation phase across the board for really silver, platinum, and palladium. When we look at all of them, I'll just go to silver as kind of the example here, but they're all the same. We had this very sharp pullback and lots of volatility. Yesterday, I talked about once you get into this explosive kind of exhaustion move, usually the market is going to trade sideways or it is going to trade downward and take a pause. If we zoom back on the charts, you can see this scenario, this scenario right here is very similar to this scenario right here. It's what we saw in gold as well. So if we take a look at the gold chart and we zoom back, typically, eventually you hit some capitulation, some volatility phase, and then the market goes sideways. We got into this volatility phase. We played this breakout, this move, went into a volatility phase, and then it's taken time to digest. And now it's kind of got some volatility here again. It's had a nice run, but it's still struggling to get traction to expand and really start to pop to the upside. So that's where we're at in the precious metal space. Gold and silver have the stronger chart patterns. Platinum and palladium, not quite as strong of the chart patterns. They're showing a little bit more weakness, which we talked about a few sessions ago as well.
After a powerful advance, precious metals are entering a digestion phase. Gold, silver, platinum, and palladium have all pulled back from recent highs, consistent with behavior following sharp momentum runs. Silver, in particular, encountered technical resistance, prompting natural profit-taking. These consolidations are healthy, often allowing markets to reset before attempting further advances. Historically, strong metals trends rarely move in straight lines. Gold and silver continue to show more constructive structures than platinum or palladium, which display higher volatility and weaker follow-through. For now, patience is required as markets absorb recent gains.
Let's take a quick look at copper. Lots of you keep commenting on copper. It's hitting some all-time highs. Of course, whenever anything hits all-time highs, it becomes mainstream media and talked about. But when we zoom back on the picture, let's just go out to the monthly chart. I'm not a huge fan of copper. It's just not something I trade or follow that much. I know a lot of you do, so I cover it occasionally. It's not definitely my expertise, or I don't know the characteristics the best, but you can see here over the long run back to 2006, it has made a series of highs up into this range, somewhere into this range. It's not precise, but we do tend to see lots of resistance. Again, we saw a big push up to where it is right now. Several months ago, and then it got slammed and crashed like 20 or something percent. Now it's back up here again. I feel like things are very frothy. I think there's a lot of news-driven moves, and we've got a lot of sentiment and FOMO and all that stuff. So I don't really trust price way up here. I know a bunch of people want to get in and chase it, and that's with a lot of the emails and the comments that we're seeing. And that is usually a red flag when everybody's talking about it and they want to get into it. It's usually one of the worst times to do it. That's what we saw right up here. It's what we've seen pretty much all of these. Whenever we get enough people saying you got to cover it, it's moving. Usually that is usually when we're getting close to a bit of a market top. So we'll have to see how this unfolds. Again, everything in the metals space, if it's a stock that says metals or miners in it, or it's a metal commodity, they have been on fire. It's definitely where the money's flowing. and that's where the attention is. And there's nothing wrong with that. It's just I'm not a big fan of the price of copper. I'd much rather stick with precious metals myself because I know them, and it's just the way it is. So I'd rather trade something I know than something I don't.
Copper has captured headlines after revisiting historic price levels, but attention itself can be a warning sign. When assets become widely discussed, speculative excess often follows. Long-term charts reveal copper repeatedly stalling near similar price zones over the past 2 decades. Each prior surge was followed by sharp corrections. While structural supply constraints exist, sentiment-driven buying can distort timing. Elevated enthusiasm, fueled by mainstream coverage and fear of missing out, frequently appears near temporary peaks. This does not negate copper's long-term role, but it does raise caution for late-stage entries. Discipline matters most when excitement is highest.
Last but not least, when we take a look at our long-term weekly chart of the SPY, this tells us when we're in a bullish environment, when we're in a bearish, you don't want to hold equities, and we're back into a bullish environment again. Now, this phase right here, this type of price action, it's been like this for quite a while here. The market is trying to figure out what it is doing. It's got a rally, and more or less it's been pausing. And the big question is it something like this, where it rallies up and then it pauses and then eventually breaks free and has a big run? Or is it going to be something kind of more like this, where it constantly, it's very similar type of price action and pattern, but then it fails and rolls over? Obviously, we had this tariff sell-off. We have a very similar type of price action from back over here, just before the tariff sell-off, to where we are right now. And we have big tariff news, I think, pending on Friday. I don't know if it's going to move the market or not. I would expect it would. But we could go into something very similar. And the technicals, in terms of the market strength, are very similar in these two phases. So we got some big, this is a real coin toss. The thing we have to stick with is the underlying trends and technicals are still up. Sometimes news can obviously create big movements and eventually turn the tides and change a trend, but we definitely don't trade based on what we think the news is going to do. We don't base our trades on fear. We trade it on technicals, on statistical analysis, on strategies that manage positions and risk. And whatever happens, happens. You can never fully navigate these markets perfectly. But just know, I think we're very close to some pretty big moves, whether we're going to see a big pop and then reversal, or we're going to see a big reversal. Either way, we just have to just mentally be prepared for some action maybe on Friday and next week. And from there, we can just navigate the markets accordingly to plan and use our position management to make sure we protect ourselves. Anyways, other than that, I think that is it for today. I don't think there's a whole lot standing out in terms of other plays at the moment.
On longer-term charts, equities remain in a broadly bullish regime, though price action reflects indecision. Markets appear to be coiling, either preparing for continuation or vulnerable to reversal. Technically, current conditions resemble prior inflection zones where news events tipped momentum sharply. While upcoming developments could trigger volatility, disciplined investors rely on trend analysis and risk management rather than headlines. No market outcome is guaranteed. What matters is preparation. Whether prices surge or retreat, successful navigation comes from respecting technical signals, managing exposure, and remaining adaptable. The next move may be significant, but strategy, not prediction, determines survival.